Hello everybody, welcome to March Madness 2023. So after all the clowns at the Federal Reserve caused a panic selling in REITs last year, this year there will be a banking crisis. So therefore when there's a banking crisis in the US, I'll buy OCBC in Singapore. So once again, accumulating bullets and firing away in a crisis. It's a bit of a pity though. I've been accumulating cash for the past 3 months, waiting for a crisis. I thought it's gonna be in the REITs again when they sell off. But well, it's been selling off. But this time round, there's a banking crisis and a financial crisis. Therefore, I buy OCBC, depleting the bullets that I've accumulated so far. So this is of course the news headline, and if you Google what's happening in the US, Silicon Valley Bank shutting down, Asian markets spoke, Asian markets falling, Singapore bank stocks falling, bank stocks falling. So again, everybody is worrying about everything again. You can see this Singapore SGX, DBS is down 1%, UOB is taking on the chin, down 2%, OCBC down 1%. So you see all the banking stocks are selling off. I think this is completely stupid because US markets, of course, is going to get into a crisis because the way they manage their banks is just ridiculous. But in Singapore, well, the banking sector is well regulated, right? Super strong. And well, I think this opportunity to buy banks, of course, quite simple for me actually. In the REIT space, things are still falling again. If you look at what's happening, it's a bit of a mixed bag though. Capital REIT, especially the stuff that I bought in last year at 86.5 cents, is now back to 86.5, 87 cents again. So taking a U trip, up and then down again, everything. But so far in the year, I've taken profit of a bunch of stuff. FCT I've sold, which I mentioned previously over here. I also sold MIT, which I mentioned over here. I think the past 1 month I've sold a bunch of other stuff as well. Can't remember. I'll have to tally it. I think I sold MLT. I have to check my records. But things are still very jittery. You can see all red all over the place, right? So of course, when things are selling off all over the board, it's time to go in and buy. So this time around, I depleted my capital and I bought OCBC. Quite a stunning thing. I was working and then look out the street at 3 o'clock, looking for my lunch break, and then tea break, I mean, and then 12:37. I thought 12:37, that's quite low, right? So I took a look at the charts and I thought, this is too good to be true. So I bought the 12:37, and then after that, just 1 minute later, it's 12:36. So I bought more, and that's it. Depleted my cash. So look at the OCBC bank shares, right? So I was looking at the charts and thinking, so is OCBC cheap or expensive at these levels? I'm not very sure actually. If you look at the 5-year charts, it's not here. This is obviously cheap, right? But too bad I didn't have too much cash to buy over here. But back then, because of COVID, the banks have to slash their dividends by a bunch because of MAS regulations ruling. Therefore, everything collapsed. But if you look at the pre-COVID, this time is at $11, right? And post-COVID over here, we're at $12, right? So that's like 10% higher, right? So it's 10% higher compared to this point, cheap or expensive? I would say that actually it's quite cheap, because actually in this period, we are in the zero interest rate environment, right? Whereas over here, we are in the high interest rate environment, right? And the more I think about it, the more I think that the high interest rate environment will be here to stay. I think even if the Fed eventually cut rates, it's not going to cut it to zero though. With all the global uncertainty, structural inflation pressures, and I think the recognition that zero interest rates just don't work. All these idiots doing all these zero interest rates in the past are just morons. Stuff just doesn't work, man. I think going forward, interest rates will not go to zero and will stay quite elevated. Therefore, it's going to be quite good for the bank's names. So, well, if banks trade at here, $11, it's probably fair that it trades way above $11 over here. So that's how I think from a very simple investor point of view. But if you look at the share price performance from a 5-year perspective, actually OCBC has been underperforming. DBS, the one in the cyan color, right, has been outperforming like mad. You see, over the 5-year perspective, DBS is just rallying away, right, led by the good work by PS Gupta. OCBC has been lagging behind, but because it's lagging behind, therefore there's good value, I think. So out of the three, I bought the OCBC. Look at the full year numbers by OCBC. I thought numbers are quite good though. Most important thing is of course the CET car, and it's at 15%, right? If I'm not wrong, this is the highest amongst the three local banks. But all three local banks have way higher CET than what is regulated. So actually all three banks are safe. But from a CET point of view, I think OCBC is the safest of the all three. Look at the NPL is just 1.2%, and more importantly, the NIM, right, is now 1.91%. It's quite decent. So the bank is able to make 1.91% in net interest margin. Quite a fair jump because of the impact of rising interest rates on the loans repricing. If you look at the point of view from valuations, dividend this year is 68 cents. So 68 cents over 12.37, which is my purchase price. This is 5.5%, right? Actually, if you can get a 5.5% yield from a solid blue chip banking stock in Singapore, why do you even have to bother about doing REITs? But of course, the REITs that I bought over the panic selling over here are yielding me more than 7%, right? 7 to 8%. Being Ames, Big Star Hill, even for Savannah, is also yielding like 6+%. So the stuff that I bought over here, even Keppel REIT is yielding even more than 6%. So there's a case for REITs to exist as well in the portfolio. But just over here is looking very attractive, right? A blue chip solid name yielding 5.5%. Why not? From a PE perspective, 12.37 divided by 1.27 is a 9.7 times. So that's 10 times earning for a solid blue chip banking stock in Singapore. Quite a solid good deal. Price to book is around 1.1 times book, which I think is quite fair, which I mentioned just now in the earlier slide. If things trade below book in the zero interest rate environment, in the high interest rate environment, they should trade way above book. Maybe like 1.2 book. I don't know. If you look at the business segments, I think this is the portion which is more concerning. You see, the CASA ratio is going down from 60% to 52%, right? Which is quite understandable because people are now outflowing the cash into T-bills, Singapore savings bonds, FDs and stuff. So the CASA ratio is something you have to catch notice and to observe. But I think by and large, people in Singaporeans are still cash rich. Very rich Singaporeans. So I don't think the cash deposits which is gonna deplete anytime soon. I think another thing is maybe the performance of GE because of the effect of the inverted yield curve. There's a valuation a drop for their business, but nonetheless the business embedded value is still increasing over time. So I think GE's franchise is still gaining strength. Wealth management is of course still improving. People are getting richer and richer, and you have an influx of rich people into Singapore as a safe haven. So I think if you look at all the segments, it's still going very, very strong. I don't think this is a weak business performance at all. Looking to 2023, the CEO said the NIM is going to be 2.1%, right? So last year was 1.9+%. So this year we'll see a further pickup of NIM by around 20 basis points, which is good, right? Because they're going to make more profit off their repricing of the loan book. Of course, barring uncertainties like recession causing credit costs to spike and tapering loan growth. But look at the Singapore economy is still growing at the low 3%, 2% region. So they're still projecting a mid-single digit loan growth. But of course, barring a big recession. I'm quite not very sure what to think about it. Last year I thought we were gonna see a very big recession happening, but look at what's happening in the US job market still very strong, right? So maybe we're gonna have maybe a soft landing indeed. I'm not very sure, but I think this is quite very sure gonna happen though. NIM is just gonna keep increasing to 2.1%, maybe even higher if you look at their guidance. I think their guidance is a bit conservative though. So if they can give you a 5.5% this year dividend yield, maybe next year we get 5.8, maybe 6%. Which is a solid deal for a solid blue chip company in Singapore, right? So hey, I bought OCBC, so good luck, man.